Today we'll be talking about banking and the creation of money. And so just some terms first. The first will be fractional reserve banking, which is a banking system in which banks keep a certain percentage of deposits on hand. Banks do this for withdrawals. The second term is required reserves. This is the amount of money the federal government, also known as the Federal Reserve in this case, mandates that a bank have on hand. This is sort of as an insurance policy to make sure the banks have enough money on hand in case there were a large demand for withdrawals. Excess reserves are just any additional reserves that a bank holds that is not required by the federal government. And then lastly, the reserve ratio is the portion of depositors' balance that the bank will keep in cash. So to see fractional reserve banking in action, I drew up this little example for you. So let's go through it. So we're starting from scratch here, and $1,000 is deposited into a bank. So $1,000 would go into cash in the assets column of the bank because they can use this money now to give out loans, which will make them money in the future. But $1,000 will also go into the liabilities under deposits because the bank would have to pay this money back at any given time. Moving on, after that, the bank has a 20% reserve rate, which means that the bank will keep 20% of that previous $1,000 in reserves, so $200, and then $800 they will service in loans, and then your liabilities will stay the same. So if you look, assets and liabilities still balance out at $1,000 each. And so moving on to the next step in this is that borrowers make purchases with these loans. So your reserves and your loans will stay the same. However, the bank will see an influx of cash of $800. This is because the borrowers took that money in the form of loans and went and paid a company or a business for their services, and in turn that company or business deposited that $800 or the sum of the loans to the bank for safekeeping. So that's why assets increases $800 in cash and liabilities increase $800. I'm sorry, liabilities increase $800 in liabilities under deposits, and this will increase your balance to $1,800. And then lastly, the bank will take this money and do what it did earlier. It's a bit of a cycle. So they'll keep 20% on as a reserve rate. So 20% of 800 was $160, which brings their total reserves to $360. The remaining cash will be added to the loan balance, so equaling $1,440 in loans. And then the deposits are added together, which accumulates in $1,800 a piece for assets and liabilities. And then lastly, today we're going to talk about the money multiplier, which is the ratio of money created by the banks through lending activities, such as the previous example, compared to money created by the central bank. And for reference, the money multiplier is 1 divided by R, which if you remember is the reserve ratio. And an example of this would be $10,000 in current circulation and a 20% reserve rate. So how would that affect the money supply? And that is demonstrated by $10,000 times 1 over zero point 0.2, which is the money multiplier, and that would increase your money supply to $50,000.